Welcome to Tonic Boom, a specialist capital markets podcast series brought to you by Tonic, the expertise-led consultancy dedicated to giving firms more. Join our host, our resident Tonic ninjas, and industry experts as we drop the mic on the hot market topics across high-profile domains such as margin, post-trade, treasury, risk, digital, legal, sustainability, and more. More expertise, more trust, more achieved. Ready for your dose of tonic?
Hello, and welcome to Tonic Boom from a sunny London town. Yes, you did hear that right. For those tuning in for the first time, Boom is Tonic's expertise-led podcast series covering the hottest topics across capital markets and beyond. I'm Chris Watts, Tonic's CEO, co-founder, and your host for today. This Tonic Boom is titled Digital Collateral, a Resilience Game Changer, ? Now, a little bit of framing up front. So there's a bit of history here. We've seen several huge market crises over a few decades have exposed major frailties across the liquidity and collateral ecosystem. During these stress events, we did not have access to the same technology solutions that are available in today's world. So specifically here, we're talking about the digital collateral solutions, so DLT platforms, tokenized assets, smart contracts. So the question we're asking ourselves today as we step back in time is, could DLT and tokenization solutions have changed the outcomes materially of these crises by mitigating some of the key impacts? So a really interesting theme, I think, and a slightly different spin on, I guess, some of those benefits and features that digital solutions are bringing us. Before we go there though, let's do some intros. So our expert guests today are blessed to have hands-on experience of the TradFi collateral world and the respective operating models, as well as the challenges, in addition to building DLT and tokenization solutions and services. So we're going to start with Kelly Mathieson, Chief Business Development Officer at Digital Asset, a true industry VIP. We're super lucky to have you here, Kelly. And I know you flew all the way from the US just for Tonic Boom. So thank you so much for that. That's not strictly the truth, but thank you for squeezing us into your very busy calendar.
My pleasure. Thank you so much. And who wouldn't fly across the Atlantic to get to the weather we're having today here? It's much better than New York, so I might end up sticking around if it stays like this. So delighted to be here today. Thank you so much. It's a topic that is near and dear to my heart. As you said, I am the Chief Business Development Officer of Digital Asset. But near and dear to my heart because I have been working in the industry, and I think of that now as being capital markets, including in its new digital flavor, for the better part of 4 decades. I spent 3 of those decades in the traditional capital markets space, almost all of it at JP Morgan, a little bit of time at Goldman Sachs, and the last decade or so at Digital Asset, where I've really been focused on how these technologies, exactly as you've described them, but how these technologies can begin to transform capital markets, maybe make some of the challenges or the opportunities I had seen previously that were either impractical or impossible to pursue become possible because of the newer technology. So delighted to reflect on history and how it might be different.
Very cool. I'm super excited to have you here. Thank you, Kelly. And on the Tonic side, we have our resident digital ninja, Stephen Czarnota. Stephen, do you mind saying hello?
Thanks, Chris. I'm Stephen Czarnota, looking after the digital domain at Tonic. So my remit is looking at applications of tokenized real-world assets, digital cash, crypto, and AI to our core domains. Background's always been business technology consulting across collateral, post-trade, probably not as many decades as Kelly has under her belt, but working them up. Most recently worked on a couple of different digital collateral engagements for our clients. So you might have seen the DTCC Great Collateral Experiment. Also working on a strategic target operating model for one of our clients moving to digital collateral as well.
Lovely. Thank you, Stephen. So we've got the right folk in the room, I think, to cover the topic in hand. But before we get onto the nerdy stuff, as usual, we have the chance to get to know one of our guests a little better. And we're going to do that via our crowd-pleasing 2 truths, 1 lie challenge. Kelly, have you managed to have a think?
I have had a think, trying to pick the things that I think might stump you. Okay. I have hiked Machu Picchu. I have a permanently broken finger. I have never been to a circus.
Are we allowed to ask which finger, or is that cheating?
No, that would be cheating. And I'm a person who talks with my hands. I'm intentionally not putting my hands up right now. And I have never been to a circus.
Stephen, early thoughts?
I'm going to go with you've never been to a circus because it seems like the most normal one. Or maybe it's a trick.
I think that's, there's definitely some logic there. Machu Picchu, I think believable. The finger one's throwing me, but it sounds so strange that it must be true.
I'm horrible at this.
I'm going to follow Stephen. I'm going to go with this.
Yeah, no, I am horrible at this. So yes, you got it right. That was the one was the lie. But I do have a permanently broken finger.
How long's that been the case?
Since I was 5, one of the kids in the neighborhood ran over my hand with a bicycle and that never really got set back correctly.
I'm sorry.
Well, so now if it's ever my evil twin that's here, you'd be able to know.
Very good. Thank you. That was great. So I guess onto the main event. Over the past 20 years, financial institutions have faced a series of systemic stress events. Too many to mention on a short podcast such as this. The 3 that we're going to zoom in on today are the global financial crisis of 2008, otherwise known as Lehman's, although we know it's bigger than that, COVID, and the more recent UK LDI crisis. So many of these crises had common pain points: poor inventory visibility, mobile assets trapped in silos, regional product silos, etc. Fragmented data, delayed response mechanisms. I think it's pretty well known that in general, these weaknesses undermine the market's resilience for each of those events. Financial resilience, operational resilience, appreciate both are in play. So I guess the way we're going to play this out is I'll give a quick refresher per crisis, key impacts, pain points, and then I'm going to pass to you guys to discuss how DLT solutions and tokenized assets, which we know are now being embraced across the industry, could have enhanced the resilience of the financial ecosystem per event. So the 2008 global financial crisis, GFC, epitomized by the collapse of Lehman's, exposed critical vulnerabilities focused on system-wide liquidity stress, triggered by the inability to quickly and transparently move collateral. After the collapse of Lehman, lenders became extremely cautious about counterparty credit risk, caused a dry up of short-term funding, particularly for institutions heavily reliant on repos for intraday liquidity. Repo markets froze, liquidity dried up. The existing infrastructure could not facilitate rapid transfer of assets to meet all of those obligations. So I guess a summary of key resilience pain points: immobile collateral, opaque liquidity pools, collateral shortfalls. As a result, it seems like we had very limited operational and financial resilience. My question to you guys is, what would have been different if DLT solutions and tokenized assets were available and widely used back in 2008? Maybe Kelly, starting with you.
What I'll say as we talk through all of these themes, just as a bit of a level set, there's nothing in any good and newer technology that is going to be a replacement for common sense of human beings. So just beginning with that, there's no sort of magic wand or magic formula that technology would have eradicated all of these crises that we talk through. That's not the perspective that we have. However, what is common as we talk through all of these, but certainly the credit crunch of 2007, 2008, there were so many things that were wrong with it. But in many ways, the crisis was exacerbated. It became a vicious procyclical swirl, if you will, but it was exacerbated by a lack of transparency on where collateral was at any given moment in time, the value of it at a current and real-time moment in time, and therefore the ability to know if ultimately I am using collateral to mitigate or manage the risk of a transaction that I'm doing, like a repo, as you said in the intro, right? Vital to the balance sheet stability, performance, and liquidity of financial markets. If I'm uncertain about that, I am going to retract from the market and pull back and start not providing that fluidity and that liquidity. And so what technology sort of failed in the crisis was not bringing that level of transparency, data, immediacy, and the ability to provide market participants, both on the borrowing side and on the lending side, with certainty and detail in the moment on their value of collateral. And if I can't get that, then I'm probably not going to lend because I'm using it as a way to mitigate lending. So there were many challenges in the market at that time, but our perspective is what becomes possible with this technology is a more real-time access to where my collateral is and what's available for use, what the current value of that collateral is in the market at any point in time. So I'm not relying on last night's market close to tell me, and if the market's moving fast, it's now, getting close to 1 o'clock in the afternoon. Is it anywhere near to where it was priced last night? Am I over or under collateralized? So you're getting to an immediacy of value. And that means I'm now able, as a market participant, to better manage my liquidity activities in the form of repo or securities lending or other financing or other credit lending. I'm now better able to manage that. If I'm able to do that, I'm probably less stressed. And then therefore the whole crisis, while having many, many things that were challenged about it, but one of them wouldn't have been this backing away from the market that many market participants did simply because they couldn't get access to good data in a real-time and immediate way.
Yeah, I definitely want to pick up on one of the points in there in terms of, I like the idea of empowering the humans with, the technology and the real-time data, and disputes being one of the key things there. So I guess that's going to be a factor in all financial crises. Is you need to be able to react quickly. Otherwise, you can be left behind, slow getting out of your positions, etc. So real-time's data is key to that. And coupled with sort of the spikes in volumes that you see in a crisis where you're going to have big valuation differences, if we're going to move to a world where there's shared ledgers for trade data, valuations, exposures, then that's naturally going to eliminate some of the discrepancies that people might be spending a lot of time investigating there. So there's probably a financial benefit to it as well, in terms of the time that humans have spent at the moment sort of manually investigating breaks, valuation differences, etc., which can be, I guess, freed up for them to do higher value activities in a world where we're on a shared collateral ledger.
May I pick up on 2 points that you said? So, because I think you made 2 really good points that I want to underscore even more. One, you said disputes, right? And so you're quite right. In the TradFi market now, for anyone who's not using DLT, many of those processes, particularly for financing and collateral management, or really anything in the post-trade space, is burdened by an inordinate amount of reconciliation. You have your systems, I have my systems. And if we're doing transactions between, and we probably are all using agents, and if we're doing transactions between us, each of those systems has to be reconciled to each other. It's sort of like at the moment the trade was done, everything was in sync, and then every moment after that, everything is out of sync. And you spend reams of dollars and lots of bodies in these post-trade operating services just handling that reconciliation. But as you know, when you move now into the blockchain space and you are able to write applications and services that are using smart contract technology, well, we can write a workflow now where we're going to agree not only at the moment of time when the trade is done, but we're going to have a common and a shared workflow and shared data, exactly as your point. So I would even pitch to you that the concept of disputes and reconciliations, second point being the manual cost of that you made, would be, I'll even go so far as to say eradicated. Now, it's hard to say that something would be completely eliminated. There's human beings involved. It's never going to be. But eradicated. And so the benefit to what you're pointing out is not only what I said about greater access to collateral and liquidity and certainty, but the cost of managing it would have been lower. And that, obviously when cost is lower and profit is higher, more of the thing that we're talking about gets done. And that's no less true of collateral management in that space. So it would have been even more fuel to the good fire, or I think of a better analogy, would have been more fuel to not being pro-cyclical and vicious back in 2007, 2008.
Almost 20 years on from GFC, 20 years on. So you can only imagine, and today we still know there's batch processes used, there's assumed settlement used at some firms, or often a day behind in terms of inventory view. So frankly, God knows what it would have looked like.
Near real time is like a dirty little secret. It's not anywhere near real time, right? Yeah.
So that it does feel like the foundation for resilience probably, and this will be a theme for any crisis. I know each crisis has got its nuances, but you have to have that immediacy of data to just know where are we at today. And then I guess moving on from that, you can think about collateral liquidity, mobility, moving assets around, but
which will come out more in some of the other themes. I quite like the word that you used in the intro, stability. If market participants have greater certainty on a tool and a set of assets that they're using to mitigate risk, to be able to enable them to do more transactions and trading and lending and activity, then you're getting to an overall more stable market condition, because that certainty on the thing that is a risk mitigant is giving them a higher confidence in being able to do the transactions and probably higher trading capacity as well.
With your permission, we'll go on to crisis 2. So fast forward, I guess that's a big fast forward. We're going from 2008 to 2020. The initial phase of the COVID-19 pandemic revealed a different set of vulnerabilities, particularly in physical asset markets and critical funding markets like US Treasuries. Lockdowns disrupted physical delivery routes, impairing the settlement of gold and other commodity trades. Simultaneously, the US Treasury market experienced a severe liquidity crunch due to hoarding and fears around intraday margining, pushing the market to the brink of freezing. Market volatility drove high margin call swings and huge volumes of margin calls, leading to high stress on collateral availability and operational teams. I know a lot of operational teams personally that really suffered during COVID and, of course, the Ukraine war that soon followed. So in terms of resilience and the key impacts here, COVID highlighted the fragility of physical settlement processes and rapid evaporation of liquidity in terms of extreme uncertainty, impacting operational resilience and market stability. So I'm going to ask you guys to unpack that one a little bit, if you can. And again, asking the same question. What would DLT have changed?
When you said unpack, that's the word I was saying in my head. There's also a lot to unpack there. Because yes, in many ways, what happened financially in 2007, 2008 was material, but COVID going on for such a prolonged period of time and impacting many different industries is almost in many ways a bigger form of crisis. But I'll make 2 points. I mean, you've raised a number of really good points, but 2 things about what you said that I think are worth making some comment on. First is the physical movement of assets. Both of my points are going to be settlement themed. First is on assets that are more physical. So I had the great pleasure of running JP Morgan's collateral management business for about a decade before I came to digital asset. And I will tell you that while everything that we've said so far about collateral availability and mobility is true, one of the number one things I talked about for the better part of that decade with our clients was, but can't we get access to gold? Gold is one of those assets that is a high quality asset, but it is not a high quality liquid asset because physically moving it around or getting it to the right location, even within the same vault, is a physical thing to be done. I mean, I keep using a word that's not manual, but it is manual, right? Okay. And I think what COVID really demonstrated was the degree to which an entire asset class can become unavailable for use in trading and as collateral because you physically cannot get it to be moved to the location that you need. And it's really kind of one of the last asset classes that is like that, following assets being materialized and now digitized. So what's different in using DLT, and this could be a whole topic of another conversation, but is the ability to be able to lock that gold bar at location in the vault and immobilize it, thereby making a tokenized version of it that has a high degree of mobility. And a tokenized version doesn't need to be physically delivered, doesn't need to wait for ships that can cross the Atlantic during COVID to be able to move again. It makes it highly fungible. So by creating a tokenized version of a physical asset and one that is so in demand in the market for use as collateral, it is the highest of high quality, maybe next to a US Treasury. It is just completely not liquid, renders that asset to now be fully liquid and able to move across borders into all different types of transactions. So that's number one. The second thing, though, is even for gold and any other type of asset, they're bound, you made the point, by settlement times. Everything that's moving in the market right now is bound by settlement systems and settlement cutoff times. And am I using a custodian who's using a sub-custodian? I had to keep backing it up by hours against the market cutoff time for processing of all of that. If you render any asset to be available now in a digital form, in a tokenized form, controllable electronic record is another way of referring to it, but in a digital form, you are unbinding and you're untethering it from the settlement systems. It doesn't need to be part of the batch process that you mentioned, right? It's sort of the batch process that you mentioned. It's now something that is immobilized at location. Custodians don't give up their assets under custody. Everybody gets to sort of stay with the existing safeguards that they have on that. But you have a version of it that can move untethered, unbounded, across borders, across settlement systems, across timeframes. So it's mostly impactful for certainly physical assets, but it applies to any type of asset that can be used as collateral. And building on our themes, if we talk first about collateral, the data that supports it, and the availability, now we're talking about DLT, smart contracts would have improved the collateral mobility.
Yeah, I think the gold use case is a really interesting one because it's actually eligible under UMR as well. So in theory, if you're a commodities house sitting on a load of physical gold, then you can start to post that as margin without having to move the actual gold bullion around. So I guess there's some financial benefits there in terms of you've suddenly got another asset type that you can optimize for. You've got additional capital that you can include in any sort of stress tests, etc., as well as minimizing the cost that you have with the physical delivery as well. Another thought in terms of, I guess, COVID as well was there was a dash for cash in terms of moving away from traditionally safe markets like even US Treasuries to either shorter term debt or cash itself. I think this was largely due to the surging liquidity demands. I think the Bank of England put out that the daily margin calls were 5.6 times the average that they were due to the extreme volatility. So given there was all this sort of selling of gilts and treasuries to try and source the cash, again, the market's going to be moving so quickly that you can't sort of plan your liquidity requirements to keep up with it. So in a future state where you can have real-time cash settlement as well, if we think about selling the security or doing a repo, if you can get that cash instantly in terms of not having to rely on the traditional cash settlement cycles, then you could receive either the tokenized deposit, a stablecoin, CBDC sort of instantly. We're still waiting for a bit of a winner out of those three, although stablecoin's getting a lot of limelight this year.
Going in that direction.
Yeah. But yeah, that could have had some good sort of benefits as well, prevent people from hoarding some of the cash as well, and I guess reduce the buffers that people needed.
Yeah, great point.
I'm going to move on, actually, to the third and final crisis. So now we're a bit close to home. We come back to the UK and 2022. So we had the UK Gilt Crisis, otherwise known as the LDI crisis, triggered by sudden move in UK gilt interest rate and yield. And this was, of course, the infamous Liz Truss budget. I don't know whether that budget must have hit American shores as well. Probably the most infamous UK budget announcement. 60 billion black hole, I think, was what was identified.
Only to be dwarfed by the big, beautiful bill.
Of course, yes. Maybe not for today, but I would love to talk more about the bill. But anyway, UK gilt rate exposed vulnerabilities in the collateral management processes, specifically of those LDI funds, massive margin calls. We've heard a consistent theme here across these crises. Collateral could not be moved fast enough to meet obligations, general uncertainty around availability, I think, of inventory. So this is the same thing we talked about in 2008 with GFC. There was actually the forced sale of gilt and there was intervention from the Bank of England. We had this temporary repo facility set up. I guess in terms of key pain points, lack of available HQLA from a subset of LDI funds, certainly, to meet growing margin calls. I know that impacted the dealer banks as well that are facing off against those funds. Data lags, I think, were a general theme here. The inability to quickly refresh, verify available collateral and margin call amounts, exposures. In turn, this created a bottleneck in the flow of assets, impacting stability. So for this one, third and final one, Stephen, maybe we should start with you, actually, bearing in mind this is on our home shore. Do you want to talk us through how DLT tokenization could have maybe adjusted the impacts?
Yeah, I think one of the topics everyone seems to talk about, especially when it relates to this, is money market funds and the transition of redeeming lots of those for cash to meet margin requirements. So a challenge for the buy side was they had increased margin needs again, mandated to hold most of their cash in money market funds. And I guess that has an impact on the money market funds if you're trying to redeem, or everyone's trying to redeem a lot of them at the same time. I guess there's scenarios where they can be gated or there can be fees to prevent a full run on those. And ultimately, I guess if the run was to happen, then you could break back on the fund as well. So there's a lot of discussion in the market, I think, from people like the FSB and a lot of the buy-side participants, that being able to post money market funds directly rather than redeem them and then post the cash might have prevented some of those issues. So assuming you can get a critical mass and a bit of a network effect, then that means that you could onwardly rehypothecate the money funds. Then I think the overall direction is that a digitally native money market fund would have been a viable collateral solution in those scenarios. And I think we're seeing some interesting numbers in terms of, I guess, AUM and revenue from some of the ones out there at the moment, from people like BlackRock, Franklin Templeton, just to name a few. So digitally native is probably the key for money market funds there, for them to be used as collateral, because it avoids some of the traditional, I guess, friction that there is with the subscription and redemption process. And again, there's a financial benefit to mobilizing those as well. That's another asset class that you can start to optimize for and prevent from remaining idle. The other point I think, which we touched on before as well, was the real-time data. So I think a lot of the buy-side firms in the LDI crisis were trying to keep up with, I guess, how the market was moving, but relying on end-of-day custodian reports from multiple different custodians, trying to stitch them together, etc. So real-time inventory, I think we touched on, is a challenge for a lot of the industry. DLT offers quite an attractive solution there. So instead of trying to piece together hundreds of thousands of SWIFTs or end-of-day reports that you're receiving from custodians, if we can move to a world where there's a sort of shared view of settled inventory, regardless of whether it's an asset that was originally issued in a CSD versus one that was issued on-chain, then that's going to empower people to have the data to make the right decisions about where they put their assets sort of in the moment. And again, it's got a financial play in terms of you can optimize more frequently, maybe more like a tri-party agent as well.
I agree with everything you said. I'll pick up on a couple of different things. I feel so badly when we think about this UK Gilt Crisis, and it's constantly referred to as the LDI crisis, because just to put it in perspective, it is, but the LDIs are pension plans, trusts, endowments, foundations, insurance companies that are arguably just doing a very sensible thing of trying to manage their liabilities with their assets and not necessarily flip their assets around unnecessarily, but they're trying to do the sensible thing of keeping that in balance. And they use as a very cost-effective and sort of very tailored, effective means for doing that, right? That's very sensible. It's a totally appropriate way of doing asset liability management. But the challenge was, and so I feel badly for them because it makes it sound like they were doing something wrong. The challenge was that the market conditions going into the fall of 2022, well, let me begin by saying that, and one of the primary ways those LDIs meet their derivatives margin obligations is with gilts. So let's just start with that. They're using the highest of the high quality liquid assets here in the UK, the thing they probably own the most of next to cash, and they're using it to meet their margin calls for what I've now just said is a very sensible form of financial management for what they do. But as you're going into the fall of 2022, arguably tied to the tail end or the coming out of the end of the COVID crisis we were just talking about, interest rates are going up and the value of those gilts is going down. And so those investors and asset liability managers are waking up in a successive amount of days, and I think it progressed over 5 to 7 days quite acutely, right? They're waking up over a successive amount of days, seeing the interest rate climb and the value of the collateral that they just posted yesterday that was fully compliant with the value of the margin they need. That same collateral now is worth less, right? And so what do? You sell securities to raise cash to be able to meet the margin call, because that's the fastest thing you can do. You've sort of run out of the high quality liquid, and maybe for a couple of days you're using other high quality liquid assets, you're using up your cash. But I've said that these are sort of pension plans, trust endowments, foundations, insurance companies. They're required to hold a certain amount of cash. They couldn't chew up all of their cash to meet their margin call. That would be irresponsible because they have responsibilities to their pensioners, right? So they start selling securities, and what do they sell? Gilts. What does that do to the price of gilts? It makes it drop. So it became the same thing that term that I used as for the 2007, 2008 of this pro-cyclical vicious cycle. It became a spiral down, ultimately, to your point exactly, where the Bank of England needed to step in and prop up the rate of gilts. So why is this relevant to DLT and blockchain and smart contracts? Well, building on all of the themes of accessibility and mobility, now let's make it intraday and make sure that as those assets become tokenized, more of them available, and they're more mobile, can the markets, the CCPs, the FMIs, can they adjust to say, I will not only be willing to accept a gilt, I'll also take it in its tokenized form, right? It's just a controllable electronic record. It's not different from the asset, doesn't trade separately, take it in controllable form. And so those same pension plans, trust endowments, foundations, insurance companies could have tokenized the gilt and delivered it immediately. So we go back to that same point of immediacy. And you're beginning to pull all these themes through the crisis. Hopefully we don't have another crisis we have to learn something else from, but you get more collateral available, becomes more accessible, you make it more mobile, and now you can move it intraday so that it can be used to meet those risks that are arising, but not create this vicious circle that ended up occurring. And that's, to be honest with you, of all the things that we've talked about, perhaps it's the most recent, but I also think it's the most acute example. Whereas in the other ones, I would have said technology would have mitigated the crisis and improved human beings' ability to meet it. I actually do think in the UK Gilt Crisis, the use of this technology would have avoided the crisis.
The only other thing I was just going to add very, very briefly on top of that is it feels like the Nirvana state as well, is we've got really narrow eligibility under a lot of these agreements today. So if there is an issue with a particular asset, it's this horrible, cumbersome process to execute the amendment to include additional assets, just to change it up. So it feels like Nirvana state is all of this is tokenized. We all have wide eligibility. If there are problems with particular asset types that we can't control via technology, which will always be the case, I'm sure, we can't solve it all via digital, then we can fluidly move around those assets, right? Rather than waiting a week for a CSA amendment, for example, or just taking things one step further. We know there's a growing number of DLT platforms on the street. So this is us pivoting now towards, I guess, acknowledging that DLT is definitely the direction of travel. It's here already, right? And if you're not part of the party, probably should be. But bearing in mind there's a number of platforms out there, and there may be more to come, including digital asset, who I know playing a really prominent role in the ecosystem. If DLT is going to become the foundation for the collateral and liquidity ecosystem, presumably we'll need these platforms to connect to one another to give the maximum resilience that we're trying to hit. I guess my question is, with a good number of platforms out there, more emerging, how critical do you guys think that cross-chain interoperability will be, and what's stopping it?
Maybe I'll start first, and thank you. It gives me an opportunity to mention the Canton blockchain, which is obviously what I'm representing. Canton, just for any of your listeners, if they've not heard about it, is a public blockchain. But unlike other public blockchains, critically and importantly, has the privacy and the permissions that are required and essential to sound operating financial market systems, right? So you get the ability to reach a ever-increasing amount of potential investors and clients and the like by being part of a public ecosystem that begins to bridge TradFi and crypto. But you have the controls and the privacy requirements that are essential for financial transactions. Nobody wants their financial transaction detail being available for the whole world to know. In terms of interoperability, the way I think about it is when you're creating an ecosystem of applications, well, an ecosystem that has different applications, and let's say each of us were running our own application. You would have your own market model and set of rules around that. You'd be able to decide who are your clients and the pricing and terms and conditions on which you permission them to be your clients, and the set of services and the economics and commercial terms under which you offer them. And Steve would be able to do the same thing, and I would be able to do the same thing. In an ecosystem, if we're using Canton as the common blockchain backend, that means you're operating your own separate sovereign, independent business and capability with your application. I am doing it and you're doing it. Now, across capital markets, we could be offering very different aspects of capital markets activity, from trade to pre-trade to trade to post-trade. And interoperability for us means that those applications should be able to connect seamlessly and allow the data to flow through them. There's nothing about that, though, that has made us have to negotiate or coordinate our businesses or commercial terms. We're each operating independent applications, but by using a common layer one blockchain underneath, our clients, ourselves, can have seamless interoperable applications across that network and that ecosystem. And so I realize when people tend to talk about this, they're talking about the interoperability between blockchains. And I think that that is a world of wonderful applications for people to sort. The way I think about it is that we're obligated to make the blockchain that we have created and the smart contract be the best it can be, and to give certainty to anyone in this ecosystem that your applications can interoperate. And there's nothing about having to have a common or a mutualized set of businesses. Instead, what we're getting is these interconnected solutions across capital markets. And that's how we think, or I think, of interoperability. One of those apps could be a way for someone who's active in Canton Network to bridge to others. And that adds a different layer of interoperability that tends to be what most people are focused on. But for us, getting to that highest order of public ecosystem with separate sovereign applications, the ability for them to interoperate, for clients to build their own solutions across the financial services and capital markets, that's the first order of interoperability that's needed before you're sort of contemplating many chains.
Stephen, is there anything you want to overlay on top?
Yeah, no, I mean, completely agree with Kelly's points there. I think if everyone builds their own walled garden, or even everyone on boards to these sort of different industry ledgers, there's going to be a need for connectivity between them. And there's the different methods that you mentioned there. I read a stat a couple of weeks ago that there are already 72 different DLT networks in use across capital markets. So it's a big number. Starting to sound like some of the fragmentation we've already created in the existing CSDs and custodian world. So like you mentioned, there's the different efforts to solve this. So there's a trend of, I guess, DLT players trying to incorporate the public element to provide broader connectivity, as well as people who have built their own sort of networks, going for the more sort of point-to-point interoperability through some of the other technology solutions out there. I think one thought as well, and this is broadly a point for interoperability outside of DLT, as well as the topic of standardization, which we seem to be hearing a lot about, all of this sort of industry bodies and forums, etc. So if each network is referring to financial attributes with a single taxonomy, so things like the common domain model, etc., then that can start to accelerate some of the transition to fully interoperable models if you're having to do less sort of system to system or ledger to ledger data mapping, for example.
Makes sense. Thank you so much, guys. That was good fun, but also I think incredibly informative for our listeners. High level summary, and I'm paraphrasing what you guys have told me, so please shout if you disagree, but previous crises, I think we're acknowledging that each is distinct in the triggers and the impacts, but I think they do reveal a fairly consistent set of pain points across the TradFi markets where financial and operational resilience has fallen down. Critical need for real-time data visibility, efficient asset mobility, robust automated operational processes. I know we zoomed in on a few different use cases there. I think what Kelly and Stephen have shared today is that DLT solutions provide a huge step forwards in addressing those challenges, moving from legacy, fragmented, batch-driven systems and processes to integrated real-time networks, data transparency. A key outcome, of course, that we all want is incredibly strong asset mobility, liquidity, resilience, which can only be a positive thing for the whole industry. Alongside humans, of course. I know Kelly was keen to stress that point, who thankfully, in the short term at least, have a role to play here in continuing to make key decisions. So I guess key message for all those listening is, if you're not already moving into DLT at pace, tokenized assets, smart contracts, take this as a polite nudge that you probably should be. Please come and have a chat if you want any information at all around where the market's heading, some of the key platforms out there, such as Digital Asset and the Canton Network. Thank you both for all of your insights. Thank you, Kelly, for giving us some time, bearing in mind I know how swamped your calendar is going to be.
No, my pleasure.
Really good fun. We will see you all at the next Tonic Boom.
You've been listening to Tonic Boom. Don't forget to like and subscribe to stay up to date on the latest developments and industry opinion across capital markets. Visit thetonicconsultancy.com to see more of our expertise-led insights and end-to-end solutions. Tonic. More expertise, more trust, more achieved.